Hello everyone, welcome back to another episode of the Investment Hound podcast. Before we get started in today's episode, there are three things that we need to discuss. The first thing is, if you haven't already gone and gotten yourself a copy of Grandad's new book, Successful Investing, How to Make Money in the Stock Market from Real Life Experience, make sure you go and do so right after this podcast. The links to the book can be found down in the description below. The second thing, if you're not doing so already, make sure you go and follow us on Instagram and TikTok at The Investment Hound to keep up to date with everything that we're doing. And number three, if you have any questions you would like to ask Grandad, or even if you have any shares that you would like us to discuss in the podcast, shoot us an email on paddy@theinvestmenthound.com. Okay, so if you haven't been keeping up to date with the previous podcasts that we've been doing, Grandad and I are doing a series here where we're building our own stock portfolio using all of the information we talked about to date on the podcast and also the information for Grandad's book. So before we start on today's two shares, we're just going to have a quick recap of all the shares we've looked at so far. So the first one we looked at is Whitehaven Coal Limited, who are a mining coal company. Number two, CVS Health Corporation, who are a healthcare and retail pharmacy. Number three, Volkswagen, the automotive company. 4, Adecco, human resources and staffing company. 5, Banco Santander, the financial services company. 6, Total Energies, who are in energy, oil, gas, renewables. Number 7, Sunoco LP, who are energy fuel distribution. 8, Ryanair, low-cost aviation airline. Number 9, National Australia Bank, who are a financial services company. 10, Bristol Myers Squibb, the US pharmaceuticals company. And 11, EDP Energias, the Portuguese energy producer. And the last one we looked at on the last podcast was Verizon, the US telecommunications company. So if you want to know what we thought of those particular shares, make sure you go and check out the previous episodes. What were you going to say, Grandad?
I was going to say, can you call me out of those shares and tell me which stock market they're listed on?
Whitehaven Coal Limited is the Australian Stock Exchange. CVS Health Corporation is New York Stock Exchange. Volkswagen is Deutsche Börse Exchange. Adecco is the Euronext.
Swiss.
Oh no, Swiss. Banco Santander is the Spanish Stock Exchange. Total Energies, is that the Euronext?
French.
Yeah. Sunoco LP is New York Stock Exchange. Ryanair is Irish Stock Exchange. National Australia Bank is the Australian Stock Exchange. Bristol Myers Squibb is a New York Stock Exchange. EDP Energias is the Portuguese Stock Exchange. And Verizon is also the New York Stock Exchange.
So at this stage, with the 12 shares we have, we must be in about 8 different stock markets.
Yeah. We have
and there's a lesson in that if you're building a portfolio, you don't just buy your own country's shares. You need to actually spread it around a bit for diversification purposes. So, for example, Portugal mightn't operate the same way as, say, give me an example, might be New York, or Canada mightn't operate the same. Well, Canada isn't one we have. Australia mightn't operate the same as Germany, and so on, right?
Yeah.
So that's what you're doing. You're spreading your risks.
Yeah, and the purpose of that is that when there eventually will be an economic downturn, that you won't be hit as hard.
Yeah.
Okay. So the first share we're going to look at in today's episode is a company called Woodside Energy Group Limited. So Woodside Energy Group Limited is an Australian energy company that is one of the country's largest producers of oil and natural gas. Established in 1954, it has grown to become a significant player in the global energy market, with operations primarily focused on offshore oil and gas exploration, production and development, especially in the Northwest Shelf and Browse Basin in Australia. The company is also expanding into renewable energy solutions and low carbon initiatives as part of its transition strategy. So, Woodside Energy Group are listed on the Australian Stock Exchange. Their sector is oil, gas, and coal. Their sector type is cyclical, because cyclical companies are those whose performance is closely tied to the economic cycle. When the economy grows, demand for energy, including oil and gas, increases, leading to higher revenues for companies like Woodside. And then, in contrast, during economic downturns, demand for energy typically declines, which can negatively affect their financial performance. So Woodside's market cap is 47.07 billion Australian dollars, and their 1 year change at the minute is minus 30.87%. The price is $24.93, and their dividend yield is 7.81%. Now that's a 45% decrease in the dividend since the previous year, meaning the dividend was approximately 11%, and 14 analysts expect the dividend to decrease by another 6% in the coming year. So that's 6% of 7.81. Can you do that in the top of your head, Grandad?
It's a little under 0.5%. So you'll still be having a dividend yield of around 6 to 6.5%. Say 6.5%.
So their dividend payout ratio is 131%. So 81% over our threshold.
I think that might be last year when they had unusual write-offs, because that's not what I have.
What do you have? Yeah.
49.06%.
No, I don't think that's right. Let me double check mine.
No, maybe it's a different period. You follow me? If you were paying 111, if you're going to be paying out 111% each year, your business isn't going to survive, right? Yet they're saying the dividend's only going to come down by roughly 0.5%. So I mean, I'd say that the payout ratio is okay.
Dividend payout ratio for trailing 12 months, 131%.
Yeah, it's trailing, you see.
So let me get back here. So their PE ratio is 17 times.
Yes.
The beta is 1.07.
Mm-hmm.
I want to look at as well their debt to total capital, because I thought this is an interesting figure. It's only 17%. So the debt to total capital ratio of 17% indicates that the company has a relatively low level of debt compared to its total capital. Mm-hmm. And that total capital includes both debt and equity. Mm-hmm. This suggests that only 17% of the company's capital structure is
Do you know what they call that, by the way?
What?
They call that the gearing ratio.
Okay.
You know the way when you're driving a car and you're in first gear, you can only do 20 or 30 kilometers an hour, a mile, right? Speed, yeah. Right? In second gear, you can do only 10 or 12, 15 kilometers. Second gear, you might be able to do 30. Third gear, you might be able to do 60. Fourth gear, you might be able to do 90. And fifth gear, you might be able to do 150, Okay. So the more you borrow, right, then the more cash you have, therefore the faster you should be able to grow. So that's why they call it the gearing ratio. Mm. Now, what did you say the gearing ratio was?
17%.
So it's only, they're only raising 17 out of every 100 by means of debt. So it's a low gearing.
Yeah.
Which makes it safe, but also makes it conservative insofar as growth will be concerned.
The revenue sources, approximately 66% come from Australia, and then America, and then Europe as well. But the minority of their revenue comes from those two. The price forecast, low, would decrease by 7.4%. And this is from Financial Times, by the way. This is what they have given us. So the low is minus 7.4%, which is bring the price down to $23.11. The medium, or the middle, is 10.8%, which would bring the price to $27.64. The high is 77.8%, which would bring the price up to $44.35. And the current price as of today is $24.93. The analysts...
So your view on that is?
I'll come to it. I think it's interesting.
All right.
The analysts rated a majority hold. Trading 212 rated Trading View rated a majority hold and some buys, and then Financial Times rated majority holds to outperforms. And we discussed outperforms in the last podcast, but outperforms means the company will produce a better rate of return than similar companies, but the stock may not be the best performer within its index. Then some interesting news articles I saw, Grandad, right? In 2022, they partnered with a similar company called BHP Petroleum. In October, they completed a recent acquisition of Tellurian, a US natural gas company, for approximately $900 million. And then in September of this year as well, they acquired a company called OCI Clean Ammonia Holding BV, who are a global producer and distributor of hydrogen products. So this one was quite a challenging one, Grandad. I thought it was genuinely, when I was analyzing it, one of the hardest ones to make a decision about, because the share price is approaching its pre-partnership lows. It's not there yet, but it's approaching the pre-partnership lows. So when they merged with the other company, the share price went up significantly, and now it's starting to come back down. The two acquisitions is indicating expansion and could also explain the high payout ratios over the previous years. So they've actually had significantly high payout ratios over the previous years as well. It could also explain, but that's good. So that shows that there's a push for expansion. And also, as you mentioned there as well, the debt to total capital ratio of 17% also indicates growth. Their 12-month price forecasts that we just called out from Trading 212 are good. The low is only 7.4% down, and the high is up 77.8%. And this would also be good for me personally to diversify my portfolio into Australia, my personal portfolio. However, they do plan to significantly drop the dividend for the next year, and the dividend yield of 131%, the dividend payout ratio of 131% is not good. So I think that maybe there is blood coming in the streets. So for me, Grandad, what I would do with this share is I would stick it on the watch list and just watch it. I think now is not a good time to make a decision to get in. What do you think?
Well, I went in for the high dividend, and I went in probably a year ago.
Okay. And
the share's down 10 or 20% in the year. So I'm bleeding from it, okay?
Right.
It also is it's moving into renewable energy, but it's heavily involved in fossil fuels. And I think some of the stuff it bought from BHP, which is another share I have, by the way, might have been some of their fossil fuel stuff, right? So I worry a little bit about them. They're on my watch list, okay? But with getting a 7% dividend, I'm hanging on in, but by my fingertips.
Yeah. I want to pull up something very interesting I saw about them, Grandad, okay? And this is what really made me question what to do with this share, okay? So just give me 2 seconds there and I'll pull it up. When I had a look at the dividends from the previous years, I was alarmed. Because the fluctuation of the dividend is extraordinary, and one of the highest I've seen since we actually began this. Okay, so in 2020, the year of COVID, the dividend was 2.7%. 2021, the dividend jumped to 8.54%. 2022, the dividend jumped to 10.59%. 2023, the dividend fell from 6.9 to 6.95%, and now they're planning to cut it again. All with extraordinary payout ratios, and the forward payout ratio of 2019, so the payout ratio for 2020 was 258%. So that's really put the nail in the coffin for me, because I thought, I was like, oh, Jesus, that does not sound good. What's your take on that?
Well, I'm hanging on in because we're going to get over 7% this year, and we're going to get over 6% next year. But I think that what drives the dividend is not just the profit, but the cash earnings. And there's a difference between the cash earnings and the profits of a business. So, for example, if I go out and I spend 500 million on a new company, and I think I'm going to get 50 million profit a year, and now I'm only going to get 25 million profit a year, I'll write down the value of that company from 500 million to 250 million. I'll write it down. But that's not a cash adjustment. I paid the 500 million last year, the year before. All I'm doing is I'm recognizing that I can't book that in the books at 500 million. So I just reduce the figure with an exceptional item of 250 million, and I'll reduce it down to 250 million. But I still have the same cash that I thought I had, right?
Okay.
To pay the dividend. So what I'm basically saying to you is they seem to be paying the dividend, a reasonably good dividend each year. But it is a worrisome share. And if I was going in today, I probably would avoid it. It also has a short-term life if it's mainly in fossil fuels. So it has a little bit of a smell around it. Unfortunately, I'm in, and I wouldn't be advising you to go in now. But we'll put it in the portfolio because it's another one we can learn from as we go along. It's not going to cost us anything to put it in the portfolio. This is just a notional portfolio we're building. But it is an interesting share.
It is.
No doubt about that.
Do you know how much roughly you have in it at the minute?
Oh, the usual 4 or 5 grand.
Okay. And what would be the threshold of unrealized losses? What percentage would you wait till it gets down in this scenario?
I'd have to get in. Will I get in and find out for you what my...
Sure, yeah.
I get the information for you now. Hold on, I put 5,500 in it. Sorry, I beg your pardon. I put a little over 6,000 in it, and it's worth 5,500 now. I'm down about 13-14%. Right?
Okay, so you have another little bit to go before it reaches the threshold.
Oh, you have. I mean, 35 is the really bad move. But I'm not confident I get that 13% back. But the dividend yield is just a surprise,
Yeah.
And so long as that's there, as soon as that starts to wobble down below the 5, I'm out of there.
Okay.
And it may not. It may not. I think it's going to be an interesting one to watch.
Yeah, I would agree. Okay, so let's move on then. The next company, folks, we're going to be looking at is a company called Emera Incorporated. So Emera Incorporated is a Canadian multinational energy company based in Halifax, Nova Scotia, primarily involved in the generation, transmission, and distribution of electricity and natural gas. With operations across North America, including Canada, the United States, and the Caribbean, Emera focuses on cleaner energy solutions and sustainable growth. The company owns and operates regulated entities, and its investments include renewable energy projects like wind, solar, and hydroelectric power. Emera's primary listing is on the Toronto Stock Exchange, which is a stock exchange we haven't looked at yet. Their sector is utilities, electricity, and their sector type is defensive. So maybe listeners at home are thinking, okay, well, these are two energy companies, but how come this one is defensive and the other one is cyclical? The answer is electricity. Everyone needs electricity in recessions and in booms. The market cap is 15.5 billion Canadian dollars. The price as of today is $53.12, and their dividend yield is 5.47%. That 5.47% is a 4.11% increase from last year's, and 11 analysts covering the company expect the dividend for the upcoming year to increase 7.19% of that 5.47%. So maybe up to about just under 6 grand. Is that right?
Yeah, bring it up to about 5.8, I think, yeah.
Yeah. Their dividend payout ratio is 110%. Their PE ratio is 17 times. Their beta is 0.33. Their debt to total capital is 60%, which is down from the previous years of 142%. Their revenue sources are approximately 75% from the United States, then Canada, then Barbados and Bahamas, but that's a minimal fraction, less than 10% of their revenue sources come from Barbados and the Bahamas. Their price forecast for the next 12 months, the lows would bring it down to minus 15.1%, so down to $45. Remember, their current price is $53.12. The middles would be an increase of 3.8%, which would bring it up to $55, and the highs of 3.12% would bring the price up to $60. So not really a significant jump either way, but an equal jump either way. The analysts rated also a majority hold. Trading View would rate it majority holds and some buys, and then Financial Times rated majority holds to outperforms. Some news that I saw from this company was this year will be the 18th consecutive year of dividend growth, and the CEO had said that this is fueled by their confidence in achieving the target of 5 to 7% of average annual adjusted earnings per share growth through to 2027. So I thought that was interesting. So for me, with this one, similar to the one before, Grandad, the dividend payout ratio of 110% is very worrying. And it seems that this dividend
Payout ratio for Emera I have here at 67.4%. I think I got the average over X number of years or something like that, and it's 67.46%. So I think you're looking at an unusual year, right? But 67 is still on the higher end, right?
So for me, for this share, Grandad, the dividend payout ratio is very worrying. And it seems that the dividend here is going to be unstable. I do think it would also be a bad idea to get into this primarily because of the dividend payout ratio. A lot of the analysts also indicate that this will be a hold, and the price targets also don't seem very attractive. It could go up 15% or down 15%. So for me, again, I would stick this on the watch list and wait and see how it does. However, what is attractive is the opportunity to diversify into Toronto.
I don't think I told you before, but I have shares in the Canadian Imperial Bank of Commerce. Did I tell you that? It's quoted in the Toronto stock market. And it's done well for me. But its dividend yield is around 4 or 4.5%. And I'm saying to myself, should I sell some of this and get into another Canadian share? Because that's the only Canadian share I have. So I went around looking for high dividend yields in Canadian shares, and Emera popped out as a possibility. Okay. So I have it on my portfolio watch list, watching it to see if it starts to outperform the Canadian Imperial Bank of Commerce. Now, the Canadian Imperial Bank of Commerce performs well in everything except on the dividend. But you know I'm a dividend junkie. But because it's performing well on everything except the dividend, it's scoring higher on my metrics than Emera. But not dramatically. I think one has a score of 10 and the other has a score of 12. Well, now, if Canadian Imperial Bank of Commerce, which is the lower one, is the attractive one. So if Canadian Imperial Bank of Commerce is 10 and Emera is 12, okay, Emera isn't as good as the Canadian Imperial Bank of Commerce. It's almost as good. So I'm watching it to see if it moves ahead. If it moves ahead, I'll sell the Canadian Imperial Bank of Commerce and buy that. But it hasn't moved ahead. So it's just there. I'm watching it. So I wouldn't be recommending you to buy it because you might want to buy a different Canadian share, you know. But I think, again, it's another country that you should be in, you know.
Do you think that viewing the payout ratio over the course of, let's say, 5 years and using the average is more accurate than using the previous years?
Well, you see, if the previous year has a cash, you know, contribution from profit, which is healthy and that can afford to pay the dividend, right? Well, it will pay that dividend. And, you know, I think the analysts are saying the dividend is still going to be relatively high, isn't it?
Yes.
Next year. So I don't think they're worried about the sustainability of the dividend. And, you know, that's a company that has been buying things and moving into other areas and so on. And it may have had to write off some of the stuff that it did, you know, because, you know, if you buy 10 companies, you know, 2 of them might be useless, you know, and 8 of them might be brilliant. But you can't carry the 2 useless companies at an overstated value on your balance sheet. So they would actually have exceptional items to bring things down. But that's only bookkeeping. The cash was paid for when you bought the bloody companies. You know?
Yeah.
So my view would be, that until you get comfortable with the payout ratio, okay, and until you're sure that you're going to be up at a reasonable dividend, let's leave it on the watch list and see what happens.
Yeah.
And I did say to you, the earlier shares that I gave you were my better shares.
Yeah.
And I said to you, as we move out, you're going to find that you're getting into my more ropier type shares.
Yeah.
But there's a learning in that too.
Absolutely. It's definitely way harder to analyze these. Even the 2 this week and the 2 last week were difficult, I thought. And I remember one thing that you said to me a few weeks ago, Grandad, because I had mentioned that to you a few weeks ago, that, because the way you pick 2, then I pick 2, then you pick 2, then I pick 2. And recently you've been picking more because I've been flat out with college and stuff like that, right? But I remember saying to you that it's very, very hard to find them at the minute. Because you said it's hard to find bargains when the stock market is up.
That's right.
When it's down, it's easy to find bargains, and now it's up. So I just thought that was an interesting observation, because people at home might be thinking that, they might be thinking, oh, maybe there's also one thing that I've noticed as well is that I have money sitting in my trading 2-on-2 account that I cashed out from my S&P profits. And I'm still waiting, and it's sitting there, and it's annoying me that it's sitting there, because all I'm thinking about is I'm losing money by having it sit there. So I'm itching to get into some, but I haven't found any yet that I'm interested in. And the ones that have good financials or have opportunity don't work from the diversification point of view, because they're American, and I want to move from America because too much of my portfolio is in the S&P, which is American. So I just thought that would be interesting for the people at home to know, because maybe other people out there in the same boat.
I presume shortly you're going to be giving me 2 more shares.
Absolutely.
So you're going to have to get off your backside and pick 2.
Yeah.
It doesn't mean you have to buy them for yourself personally, but you're going to have to pick 2 shares that you think are worth a shot at,
Yes. Okay. I will do that for the next episode.
Like the one type of shares that I don't have are what they call growth stocks.
Yeah. Maybe I can pick a few of them.
Like the growth stocks are where there's a rapid and continuing increase in the share price. And they don't tend to have great dividends, right? So I don't pick those. And that nearly gets rid of all the technology stocks. Now your uncle Owen, my son Owen, is heavy into technology stocks, right? Because he's younger than I am, and he can afford to have a go at it, right? At my age, I can't afford to having a go at things I know nothing about.
Also, sorry, hold on, just to stop you there. Also, he would be far more educated in that field because he does own an IT business.
Yes, he does.
So, yeah.
But how well educated he is in some of these growth stocks, I'm not sure. Because I've been trying to get him to get into artificial intelligence, right? And it's not easy to get him to move, Yes, well, he's kind of got his comfort areas that he's in, and they're not necessarily fast-growing areas.
Well, I think at the minute anything artificial intelligence related is extremely overpriced.
Yep.
So,
well,
maybe he's right.
You're going to have a look at a couple of shares. You're going to have to come up with a couple of shares.
Yeah.
But it doesn't matter. We're only putting them in to see what the portfolio looks like when we get to 20 shares.
Yeah.
And then we start to play with them to try and balance the portfolio, et cetera, et cetera, et cetera.
Yeah. Okay. I think we'll wrap it up there, Grandad.
Okay.
2 interesting ones for this week. Ladies and gentlemen, if you haven't already gone and got yourself a copy of
Can I ask you a question?
Of course.
Can I ask you a question? Do you have a break from college in the middle of the term or whatever?
Yeah. End of next week.
That's great. So then you'll be able to do the 2 shares during the break, will you?
There you go. And we also have a very, very special episode coming out next week as well that the listeners will be interested in, guarantee it.
Why don't you tell them what it's going to be about?
Well, no, we'll leave it for a surprise, Grandad. I need to build it up and, apply my marketing knowledge to promoting it. Okay.
You know the way that my grandson thinks that his granddad is brilliant, right? My problem is that the guy next week, I think my grandson probably thinks he's more brilliant than his granddad.
No comment. No comment. Okay.
All right.
Ladies and gentlemen, if you haven't already gone and got yourself a copy of Grandad's new book, Successful Investing, How to Make Money in the Stock Market from Real Life Experience, make sure you go and do so. You can see 6 copies of it above his head if you look at the screen right now. Also, follow us on Instagram and TikTok at The Investment Hound. And if you have any questions for us, shoot us an email on paddy@theinvestmenthound.com.